Assalamualaikum warahmatullahi wabarakatuh. To my lecturer and my fellow classmates, my name is Raja Muhammad bin Rajesh Shamsuddin from Group 3. So today, me and my group mate will be presenting regarding implementing wealth tax may get tricky in Malaysia. So, my group consists of 5 members. The first one is Farah Adila binti Muhammad Sharizal. The second one is Zaki Ashraf bin Baharin. The third one is Nur Sharina binti Muhammad Shah. And the last one, Nur Shafiqah binti Ahmad Subian. Next, I will pass to Zaki to summarize the article.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Zaki Ashraf bin Baharin and I will present about the summary of the article. First, the article states the Malaysian Association of Tax Accountants Deputy Secretary General Dr. Muhammad Fairuz Abdul Razak has discussed and challenged an implication of introducing a wealth tax in Malaysia. He notes that wealth tax is a complex issue, primarily due to the mobility of affluent individuals who can easily shift their wealth to other tax jurisdictions. Tracking wealth held abroad and valuing foreign assets for taxation purpose is also a significant challenge for tax authorities. Secondly, the article highlights that while wealth tax may potentially increase national revenue, it could have unintended consequences. For example, it might lead shareholders to delay selling assets to avoid intermediate taxation, causing a lock-in effect that affects the equities market efficiency. Next, in response to Singapore's recent tax increase for its wealthiest citizens, the large Malaysian tax leader Sing Kuan Gek proposed that Malaysia could explore similar measures like raising the personal income tax rate for high earners. However, she notes a limitation to this approach as it predominantly affects individual informal employment, excluding high-income earners in categories like freelancers and business owners. To address this issue and enhance tax collections, she suggests the implementation of a tax identification number for all nations above 18. Combined with stronger enforcement efforts, this could provide the government with increased visibility on taxpayers and potentially lead to higher tax revenue for the country. That's all from me. I pass to the next presenter Sharina to present the introduction of wealth tax.
My name is Nur Sharina binti Muhammad Shah and I'm going to continue with the introduction. So one of the various tax proposals put up by the 2020 presidential candidates that aims to raise money mostly from the wealthy is a wealth tax. However, it is believed that Malaysia does not have a wealth tax specifically. Wealth taxes generally have an exemption amount which is excluded from the tax base. Wealth taxes are relatively uncommon globally and are not a standard feature of many countries' tax system. Next, the main tax system in Malaysia is income tax, which is divided into corporate income tax for firms and personal income tax for individuals. Tax laws and regulation can change, so it's crucial to rely on the latest information from the official sources. Lastly, the unique feature of a wealth tax is that it will create a whole new tax system different from the current federal income, payroll, estate, and consumption taxes. If there have been changes in Malaysian tax regulation or the introduction of new taxes, including a wealth tax, it needs to refer to the latest information provided by the Inland Revenue Board of Malaysia, which is Lembaga Hasil Dalam Negeri, LHDN. I will pass to the next presenter, Farah, to present about the issues of implementing a wealth tax in Malaysia.
Assalamualaikum, my name is Farah Adila binti Muhammad Sharizal. I will presenting about the issues on implementing wealth tax in Malaysia. In considering a wealth tax in Malaysia, we must address critical challenges for an effective and fair tax system. This essay explores 5 key aspects, offering insights into the complexities and potential solutions for wealth tax implementation. The first point is wealth mobility and tax evasion. Wealthy individuals seeking to mitigate the impact of the wealth tax may resort to relocating assets offshore or restructuring their holdings. Rich people might try to move their money to avoid the wealth tax. To stop this, Malaysia needs strong rules and penalties to make sure everyone follows the tax laws and keeps the system fair. The second issue is exemptions and deductions. Deciding which assets should be taxed and figuring out what to exempt or deduct is a complex job. Malaysia needs to do this carefully, considering the different types of assets and how they contribute to the country's wealth. And the third issue is compliance and enforcement. For the tax system to work well, people need to honestly report their wealth and pay taxes on time. Malaysia must set up strong rules and penalties to make sure everyone follows them, keeping the wealth tax system trustworthy. Encouraging people to follow the rules helps share the tax burden fairly. Another issue in implementing wealth tax in Malaysia is international considerations. Malaysia needs to think about its connections with other countries in the global economy. How Malaysia deals with other nations affects foreign investment and the chance of paying taxes in two places. Finding the right balance between local tax rules and working with other countries is important for a good environment for both local and foreign investors. Last but not least, legal and constitutional challenges. Putting in a wealth tax might run into legal and constitutional problems. It's crucial to make it fit with Malaysia's laws to avoid legal issues. Dealing with any potential constitutional problems ahead of time and making sure the wealth tax follows the country's legal principles will make it more legitimate and effective. In conclusion, introducing a wealth tax in Malaysia needs a careful plan that deals with moving money, exceptions, following rules, global matters, and legal issues. If Malaysia thinks through these things well, it can make a fair and clear wealth tax system that matches its economic goals, promoting stability and fairness. That's all from me. Next, I will pass to the next presenter, Shafiqah.
Thank you, Farah, for explaining the issue. Hi, my name is Shafiqah, so I will discuss about tax framework in Malaysia. Regarding that, related in offshore asset system to evade taxes is generally considered illegal and unethical. It's important to distinguish between the legal tax planning and illegal tax evasion. Legal tax planning involves using legal methods to minimize tax liability, such as taking advantage of tax incentive or deduction within the bounds of the law. It's crucial for individuals to comply with tax law and regulation in their respective country. Tax authorities are increasingly focusing on international cooperation and information exchange to detect and prevent tax evasion. So, is related to individual income tax that individuals who live in Malaysia are taxed on their worldwide income. So, the next is corporate income tax. In creating a fair and effective tax framework, involves thoughtful consideration of wealth tax coverage and exemption. Wealth taxes are designed to address economic inequality and ensure that individuals with substantial assets contribute their fair share to public finances. However, it's crucial to strike a balance to avoid unintended consequences and ensure that the tax system remains fair and efficient. The issues surrounding corporate income tax and wealth tax are complex and can vary based on the specific tax policies implemented in a given jurisdiction, which is tax rates and progressivity is the level of corporate income tax rate, and their progressivity can impact business differently. The third one, Malaysia's global relationship play a significant role in shaping its economic policy, including consideration related to wealth tax and foreign investment. When evaluating how wealth tax may affect foreign investment, it's essential to take into account various factors including the good and service tax, like global mobility of wealth, which is wealthy individuals often have the flexibility to move their assets globally. RPGT. When implementing a wealth tax in Malaysia, legal hardness and constitutional compatibility are critical considerations. One specific aspect to align with Malaysian legal framework is the real property gain tax. RPGT alignment is specific to gain from the disposal of real property. In summary, aligning a wealth tax with Malaysian legal framework, especially in relation to RPGT, is crucial for its successful implementation to ensuring constitutional compatibility, protecting property rights, and addressing legal challenges through proper legislative processes contribute to legitimacy and effectiveness of the wealth tax system. Next, I will pass to next presenter Raja for explain the recommendation.
Thank you, Shafiqah. So next, for my part, I will explaining regarding the recommendation that the Malaysian government can implement to improve tax revenue in Malaysia. Wealth tax is not a good option to increase tax revenue in a developing country such as Malaysia. Government should restructure country tax code to improve economic performance. A well-structured tax code is easy for taxpayers to comply with and can promote economic development while raising sufficient revenue for our government priorities. In contrast, poorly structured tax system can be costly, distort economic decision-making, and harm domestic economies. Instead of trying to implement wealth tax in Malaysia, which can be quite tricky, the government can try improving our current tax framework by adopting some effective strategy from the Estonia's tax system. For the 9 years in a row, Estonia has the best tax code in the Organization for Economic Cooperation and Development. Its top score is driven by 4 positive features of its tax system. First, it has 20% tax rate on corporate income that is only applied to distributed profits. A corporate tax is a tax on the profits of corporation, but in Estonia, tax on the company profits only on final tax and dividends paid. Credited or distributed income, shareholders do not hold any obligations to pay tax for their company. Second, in Estonia, it has a flat 20% tax on individual income that does not apply to personal dividend income. The third one, in Estonia, its property tax applies only to the value of land, rather than to the value of real property or capital. Finally, in Estonia, it has a territorial tax system that exempts 100% of foreign profits earned by domestic corporations from domestic taxation, with few restrictions. A territorial tax system for corporations, as opposed to a worldwide tax system, excludes profits multinational companies earn in foreign countries from their domestic tax base. Countries enact territorial tax system, also known as source-based tax system. This allows multinational business to exclude or deduct foreign earned income from their domestic tax base, ensuring that such profits are only taxed in the foreign country in which they were earned. Therefore, if Malaysia tries to adopt some features, it will help increase tax revenue and help improve our economy, because the absence of a wealth tax on the disposal of investment or capital assets is one of Malaysia's competitive advantages in the global investment market. Thank you. That's all from me. Next, I will pass to the next presenter, Zaki, to conclude our presentation for wealth tax implementation in Malaysia.
Thank you, Raja. Last but not least is a conclusion implementing wealth tax in Malaysia. Implementing a wealth tax in Malaysia is a complex endeavor with various challenges and potential consequences. While it could provide additional revenue for the government, it is important to carefully weigh the benefit against the drawbacks. The mobility of affluent individuals, difficulties in tracking overseas wealth, and the possibility of unintended consequences like asset lock-in and increased tax disputes all underscore the need for a thorough and comprehensive assessment of any proposed wealth tax legislation. Decision regarding wealth taxation should be made with a clear understanding of its potential impact on the investment climate, economic efficiency, and equity, while ensuring that the tax system remains fair and administratively feasible. Malaysia must strike a balance that aligns with its economic goals and values while taking into account the realities of the globalized, dynamic financial landscape.